What is going on, everyone? Eric here, Travel and Trading. So, today we are going to be covering streaks of wins and losses when it comes to your day trading. So, I don't know how to put this, but this is going to be probably one of the more detailed um, videos we're going to do here within the course for those that are watching this course. For everyone else, just might be watching like the free version on YouTube or whatever. Still going to be a lot of information, but hopefully not too much to where it's going to overwhelm you. Okay. Um, But yeah, so we're going to discuss how to handle wins and losses and everything else in between when it comes to the psychological aspect of trading. I wanted to cover this, especially in the psychological section of the course, because there's not a lot of mentioning about this, you know, throughout the whole trading community and YouTube and stuff like that. Even though it's probably a third of what's important when it comes to day trading. So let me ask you. I mean, for those of you who are probably watching this, of course, and who are advanced traders or kind of understand all this here, have you ever had like, a time where you had like a good win streak going on and then, one trade just wipes out all your hard work you did over the last, few days or weeks or so? Or you ever had like a streak of losses and, been afraid to take the next trade because you think it's going to be another loss kind of thing? Those instances. So what we're going to discuss here today is going to fall in the realms of all that and even more. Okay. Um, and so again, for those of you that are watching this, this is going to be kind of a more, intermediate and advanced, video for traders who are already experienced in trading and, been through the ringer before and stuff like that for, probably been trading at least, 2, 3 years or so. If you're new to trading, you can probably skip this video because most of these concepts might go over your head. But it doesn't hurt to learn a little bit more. So, but understand you probably want to come back to it later on to kind of retackle it and, get a better understanding and conceptual grasp of this, part of trading. So yeah, so that's what we're going to discuss here in this video here. These little charts here, just kind of showing you, little entries here of, win streaks and loss streaks and stuff like that. So this is just kind of giving you like a little idea of, why you guys, of course, too, should be logging your trades in your trading journal. Whether you're a beginner or advanced, you should be doing that. Until you become an expert to where you're doing this and this is your only occupation, you need to be journaling your trades, okay? So you can get to that point. So do it. All right, so let's go ahead on to the next one. So again, like I said today, what we're going to cover is a few different topics. One of the things we're going to cover here is going to be, the reality of wins and losses. You guys might be seeing like advertisements and things like that from, unfortunately other gurus and traders and things like that. That doesn't really cover much details about wins and losses and how it works in the market on a day-to-day basis. So we're going to cover that. We're going to discuss like common fallacies when it comes to the, day trading. We're going to talk about the wins and losses and the psychological effects it has on your actual trading. We're going to talk about how to bounce back from losing trades. And we're also going to talk about, what to watch out for when you do consistently win. So those are the key things we're going to touch on in this video for those of you who are watching, like the free version on YouTube and all that stuff. Now, those of you that are watching this in the course, we're going to go a little bit beyond that, okay? There's also going to be a little bonus lesson for those of you who are watching it on YouTube as well too that I'll cover as well for you as well. But for those of you who are not and watching it in like the course, we're going to talk about how you're going to be able to consistently win more often than not. We're going to talk about overcoming these fallacies that we're going to discuss here that you're going to experience in the market. And I'm also going to talk about how it's going to be able to, increase your win strategy and actually a little bit more. We're also going to do like a little, live walkthrough here together and all that good stuff too. So yeah, let's get ready for it. But sit tight and get out your notepads and let's get into it. Okay. So yeah, but yeah, this is going to be very important for the psychological part of trading. Okay. And to be honest with you, for those of you who are watching this and you already have a good strategy and risk management, this is going to be nice because this is what's going to set you apart from pretty much most traders that are in the market, because all they really understand is a little bit of risk management and a little bit of, strategy. All right, so let's go ahead and get into it. Sorry if you see me drinking a lot as well too throughout this video, because I might get really thirsty with all this talking I'm about to do. But I'll try to make it as simple as possible for you guys. Now, let's talk about the truths about wins and losses when it comes to day trading. Understand this. And I experienced it today. Posted in the Facebook group. I even posted a loss and everything like that too. Losses will happen, guys. Okay? It is inevitable. Um, there's no getting around it. You got to learn how to lose in this field. Okay? If you're a person who thinks you got to be right all the time, you don't need to be day trading. I'm just going to tell you that right out the gate. I'm sorry if this, is upsetting you, but you can have everything go right and you'll still be wrong when it comes to the market. Okay. So understand that losses will happen. There's no getting around it. There's not one strategy out there that will prevent you from losing. Um, Nothing like that will exist, or probably more than likely will not ever exist, just because of the aspect of how day trading and just trading in general works. If you understand that, you'll be okay. And if you can learn how to accept losses, you'll be okay. Um, Understand too that in the beginning, especially for you new traders and even some of the more that want more advanced, even if you've been doing this for a couple of years, in the beginning you will lose more than you win. There's even instances where even when you're being, successful and kind of have a good grasp, where you might still lose more than you will win. That is just a fact. The more you lose, the more gracious of a loser you become. And this is why I consistently say, even when you're managing your risk, we'll talk about this in the risk management section, you want to be okay with trading the amount of money you are able to lose. And if you're not okay with that, don't trade it. Ask yourself every trade, if I lose all this money, if this trade I do goes to zero and I lose all of it, will I be okay? If the answer is no, probably shouldn't trade it. The next thing you want to understand about the truth about wins and losses is that you're going to have to learn to lose. The best traders are the best losers. Point blank, period. And by best losers, I mean they let it affect them not too much. You're human. You're gonna be affected by the trade's losses. That's just part of life. But it doesn't just completely throw you off track. If you're a sore loser, this ain't for you. You better become a great loser. All right. Um, Understand that your first few wins will more than likely be luck, especially in the beginning. Um, and I want you to understand that having losses, guys, doesn't necessarily mean that you have a bad trading strategy. It just might mean that the market conditions might be just different. You might have, different types of stocks that you're trading, along with a bunch of different other factors. So don't always assume that your trading strategy is bad just because you're losing. It could be other little points that you're, not catching on, which is why I say it's good to have a community to help, help you look at that stuff. And we do it all the time, in the chat room and alerts. So yeah, no worries. But also to understand that it's possible for you to win, consistently right away. I don't think that's a good thing. I've seen traders who have done it, and the moment they lose, which will inevitably happen, they're done. That's it. It's not a good thing. I'd rather you lose a lot in the beginning and still keep fighting your way through, because by the time it does click for you, especially as a trader, you'll be in a much better position. This is something that I didn't understand. A lot of new traders too don't really understand as well too, and even advanced traders. They think that because they won consistently right away in the beginning, they were profitable, that, hey, they can quit their job. This is the best thing for them. And this is because of the fact that they haven't lost yet. And that is not a good thing. If you lose a lot in the beginning, you'll be in a much better position to understand that it is possible, and you'll be much better at, protecting your account and being able to grow profitably. Okay. So understand that. That's what we're going to, uncover about truth and losses. So if you're not ready for this stuff, stop trading. All right. So the next thing here we're going to talk about is just basically common fallacies when it comes to with streaks. So one of the things that a lot of traders fall into, let me just kind of rewind it. What is a fallacy? Because some of you guys may not even know this. A fallacy basically is just like a mistaken belief that a person develops based on unsound arguments. There's no, reason behind it. It's just something that they conjure up, and it's not, solidified. There's no reason or anything like that behind it. And as humans, we develop these fallacies all the time, not just in trading, but in life in general. So the ones I'm going to talk about are going to be fallacies that pertain to trading. And probably as I go through these lists here, guys, you're going to probably feel like, hey, this did apply to me at some point in time. And we're going to break that down. So one of the first ones we're going to talk about, probably one of the most popular ones here, is the gambler's fallacy. So with the gambler's fallacy, this is basically incorrectly overstating or understanding the likelihood that event is going to happen based on a series of past events. It's very common in things like roulette. I think that's where it like kind of comes from there. That's kind of like one of the best examples, I believe. But also there's like an example like with flipping the coin, the 50-50 chance. It's either going to land on heads or land on tails, right? So basically the probability of the 50% that is going to land on heads or tails is not going to change no matter how often you flip this coin, okay? It's going to either land on heads or tails. Just because it previously, let's say you flipped it 10 times in a row, and let's just say like the last, 7 times it landed on heads, that doesn't imply or change the odds that the next one is going to be heads or is due to be tails because it's been on heads so many times. Your 50-50%, 50-50 chance does not change. As the name implies, it's basically a gambling fallacy. You're thinking that it's going to change based on past events. So do not fall into that, fallacy. Seen that happen a lot of times with traders, and when they're managing their risk, their assumed is going to be much higher than what it is because of the fact that the stock has, does some other movement. It's not going to change. All right. Yeah, so kind of keep that in mind. The next one here is like the confirmation bias. Um, so with confirmation biases, I'm not going to get like, you know, conspiratorial or, political or anything like that, but confirmation bias is basically a fallacy that happens when you tend to seek out information that is going to confirm something you already believe that's going to happen. In the world of trading, this is like saying, oh, you're doing your research on your watch list or anything like that, or just trading throughout the day in general. You're going to assume that, hey, this stock is going to move because of the fact that short interest has grew and this news came out, blah, blah, blah. Earnings are reporting and it's been a great season for this market and it's in that market. Those are confirmation biases. You're looking for reasons to have the stock do something that you already assume is going to do because it may have done it, before, or you would just have that belief basically that is going to do that. That is a wrong side of the track to get on. And this is why a lot of times too, I always tell you guys it's better to play the reaction instead of trying to guess what a stock is going to do. Play what it's doing, not what it's, not what you think it's going to do. Play what it's doing. Trade what it's doing. All right. So confirmation bias is one of the things that a lot of traders fall victim to. Don't do it. All right. Law of small numbers. So like, for example, have you ever tried trading like a handful of trades and then assume that, after you do the trade, it doesn't work after a few times? If you've done that, you've been guilty of this little small numbers trade law, law of small numbers. A few trades is not going to be a big enough sample size for you to be able to give and get significant information on the quality of your trading strategy, guys. Those of you that are in the course, we're going to discuss how to, quantify that and how to do all that here when we're done. But understand that the law of small numbers applies to a lot of traders when they're testing out the strategy or even trading their strategy, and then a few bad trades happen, and they think that's enough to say, oh, my trade doesn't work. Doesn't work that way. All right. Survivorship bias. So this right here, it's more along the lines for investors, guys, not necessarily traders, but it still should be considered and known as a fact as well too. But with this fallacy, basically kind of breaks down like, how most stocks all go up. You hear it all the time, and we even make jokes about it and like Wall Street bets and all that stuff. Hey, stocks only go up, right? So although this is true, that data is kind of skewed because it doesn't take into account stocks that may have already failed or even merged. Historically, stocks do go up because of the fact that the company is still lasting a long time. But that sample size of the stocks going up doesn't account for all the stocks and companies that went under. Okay? So don't think that, oh, just because a stock is, still in the market, it's still potentially a good stock. It's not always the case, especially with these small caps that we trade all the time and low float stocks. And definitely for those of you who trade like OTCs and penny stocks. Yeah, so survivorship bias is something A lot of traders fall into, especially when they're back holding. Learn to cut your losses. Next thing here, correlation does not imply causation, okay? Um, this is big because it's kind of a double-edged sword. Commonly, traders will mistake correlation for causation, and that's often, treated as if it does. Unfortunately, it has it's a weird psychological effect. And there's different types of, correlation and causation effects. But basically, like for example, with the sympathy play or news coming out, people might think that, oh, because this news came out, it looks good and it's going to cause the stock to run. Not necessarily. And you'll see plenty of times that happens. So kind of keep that in mind. Okay. Or also too, like stocks like sympathy plays. We talk about that all the time. If, stocks in the EV sector are moving because of, Tesla earnings were great, that's going to actually cause other tech stocks like Lucid, NIO, or any of these other, manufacturers, Mullen, all these guys, is going to, be correlated to their movement. It's not always the case, okay? Correlation does not mean causation. Understand that. So those are some fallacies you guys want to look out for. Let's go on to the next ones here. So hindsight bias. This was a popular quote by Daniel Kahneman, I believe his name is pronounced correctly. I remember seeing that too as well somewhere. But basically, hindsight bias, might spend a second on this, but a stupid decision that works out well becomes a brilliant decision in hindsight. A lot of you traders, especially when you're reviewing your trades, are going to think, man, I nailed that trade. You did not plan for that to happen. This is another thing that a lot of traders struggle with. You have to be true to yourself, especially when it comes to reviewing your trades and reviewing your journal and actually doing your trades. Just because the stock worked out well doesn't mean that it was a great decision. And I've said this a couple of times, like in the Facebook group and stuff like that to you guys. I'm like, man, yeah, I came out green on this trade, but I hate that trade, even though I'm green, which is great financially, but mentally as a trader, I'm like, yo, this was a bad trade, terrible trade. I don't know why I did this. I really just got lucky. You got to understand that, okay? And you got to figure out when to find that. It's so obvious, and a lot of traders fall prey to like the hindsight bias. It's a very flawed way to think about your trades, because a trade that has a 70% chance of making $200 and a 30% chance of losing $100 is still a great trade, yes, but no matter the outcome, even if 3 out of the 10 times, the trade that you make there. Excuse me, I need some water. I'm sorry. If 3 out of the 10 times the trade that you make there is a bad trade, sadly, that's going to be just how it is. You got to understand that. And many traders will evaluate their trades that way. But hindsight bias is like one of the ultimate reasons why technical analysis is so attractive to traders, and why all these gurus and people like that you see, told about it, because they're finding patterns in historical charts that make it very easy, to benefit from hindsight, that things aren't nearly as easy, okay? And I think when I started as a new trader, to be honest with you, this was one of the things that irritated me the most once I kind of got a little bit into it. I'm like, man, all these traders are, showing me, and I'm seeing like online, okay, oh, this pattern formed, it was easy to figure out. But then I started realizing, wait, this is all happening after the fact. Hindsight bias, guys. Like, okay, now tell me about the other trades. You know what I mean? So, and this is why you'll see a lot of traders and stuff like that promote. I've probably been guilty of probably doing that too. But of course, for those of you who see me trade live, you see me trade live, and those of you that are not, obviously I don't want to tell you the trades that I'm in until they're done, because I don't pump and dump kind of thing. But understand, hindsight bias is something that you got to be aware of, especially when you're reviewing your trades. Don't fall victim to that. Now, recency bias. I call it, basically, it's just short-sightedness. Recency bias is basically a logical way of putting like more weight on the importance of like recent events compared to historical ones. This is why I tell you guys looking left is very important, because not only do you see, more about the stock, you get the overall bigger picture, you find different levels of resistance and stuff like that. That's why that is important. because oftentimes a new press release or something like that could come out, stock starts moving, great news, blah, blah, blah. But people forget, like, oh, they just reported horrible earnings, like, not even a month or so ago. Having that recency bias and, short-sightedness is going to cause you to have your risk to rewards be way off whack and can eventually cause you to, you know, lose your account. Okay. But this can be easily observed by looking at like cyclical nature of markets. The longer the bull market is, the more people forget that prices don't only go up. And you guys are actually seeing that now in this year here in 2022 that we're in. A lot of people jumped into the market at 2020 during the pandemic. Everybody was bulling out. You could close your eyes and throw the dart at the ball and at the wall and your stock will go up kind of thing. But people forgot that 2008 really wasn't that long ago, and we're still kind of coming up off of that stuff too a little bit. So now we're at the point where things are coming back down and traders are getting burnt out. We're not even a year into it to where Fed's raising interest rates, and I've seen so many people stop trading because they just don't know what to do. But they've fallen into that. They jumped into the market during that recency bias. They've seen that things have gone up and try to get up in it. So eventually it does have to come back down. Understand that. It does have to come back down. That's why you need to find those levels of support to know where you can manage your risk. But the same is, the case after the market directly crashes too. This is when people typically overmanage their risk because they overestimate the odds of future drops. And you're seeing that now in this market. Everyone that is still in it and still kind of new to trading are panic selling. They're taking their profits much, sooner and stuff like that because they're assuming that the stocks are going to, drop some more. They're cutting their loss and things like that because of the fact that that's, what's happened recently. And of course, a great time to sell stock and stuff like that and insurance products and options and volatility happens during those times. So I don't trade options, but you guys know what I mean there. So pretty simple there. Attribution bias, I like to call it press release pricing. And this is kind of similar to what I was saying earlier. Basically with this instance here, attribution biases basically is a bias that can be observed by like trading the news. Is like press release companies, they're in the business of, contributing to the attribution bias. It's where, they're consistently trying to assign a reason in an event to the reason of, what's going on with the reality of a stock. So like, for example, financial news companies, that's what they do. They satisfy that bias, the attribution bias. They seem to have an explanation every single time a price might move on a stock, or explanations, if they're there, are sometimes contradictory. So understand that sometimes you just can't break down price movement into a simple cause and effect relationship. And for those of you who were in the course in the beginning, the How to Day Trade for Beginners course, when I talk about the catalysts and stuff like that, this is why this is just kind of like one thing on the checklist. It's not an all kind of thing. This is for you just to understand that this might be possible to be an attribution to why the price might move. Of course, if you caught it earlier, because other traders are going to be looking at it and things like that and assuming this because they don't understand this. They don't understand the attribution bias that these press release companies put this out there to cause these prices to move because people will think that due to that bias. They play on that, guys. Understand that. And a lot of times for you, those of you who might trade like penny stocks, stuff like that, you'll see pump and dump schemes where they do stuff like that too. So that's basically what they're doing there. So the problem is for every trader, they just kind of assume it doesn't just stop at trading, but this, is a problem against humans, period. Even though, we understand how things work, so like that, we're always good at finding explanations for almost anything. And even if an explanation doesn't exist, that makes sense. We'll utilize that as, a bias. So basing your trades based on this kind of explanation does more harm than good, guys. Don't think that, oh, I got to get into the stock because a press release come out. And that's why a lot of times too, you'll see in the alerts, hey, this press release did came out. You still need to watch the stock and see if it moves and get you in that trade to where it's, in a position to where you can possibly profit off of it. Look at level 2, look at all these things, okay? So you'll see why all this stuff is slowly starting to come together, guys, and understand that. Last but not least, biggest one of it all, sunk cost fallacy. We're going to go into deep detail this afterwards as well too. Now with the sunk cost fallacy, guys, this right here, I call it bag holding, and you guys know how this is. I can probably almost guarantee you that at one point or another, especially those of you who try to day trade, have been a victim of sunk cost fallacy, and I've done it myself, and even till this day, still sometimes may do it. I've gotten a lot better at it over the years, but oh man, especially you new traders, you're gonna be victim to this. Basically, what the sunk cost fallacy, guys, is kind of think about it like this. Have you ever had a time where you were in a trade or a position longer than you probably should have been? Or have you ever, if you've done that, you're guilty of the sunk cost fallacy. But basically, it's the tendency to refuse to stop any action that you're doing because of the fact that you've already sacrificed so much, money or time into it. Sometimes, it's best to just cut your losses and then move on than to further keep wasting money and time on something that's, worthless. Okay. Sunk costs should be, should not be a good reason for you to continue to stay in the trade. Okay. Don't think just because, oh man, I already thrown so much money on it, or this is like the fifth time I done lost, or I was wrong in my trade, I'm just going to stick it out and hope for the stock to come back up. That's a no-no. If you wouldn't open your trade where it's currently at and with the price level, then you shouldn't stay into it. Okay. Regardless of how much you already sunk like money into it, that cost is done. Okay. Sunk cost fallacy, guys. I can't preach it enough. Cutting your losses quickly. Do not bag hold, because you never know what can happen with these companies in bull markets or bear markets. All right. All right. Now let's talk about the wins and losses here. Now understand, again, losing is a part of the nature of your career when it comes to day trading. Okay. The effects of these things here, especially with losses, it can easily cause you to be an emotional trader. Nobody likes losing. That's probably, again, just human nature. Doesn't mean that, you're a bad trader or anything like that necessarily. You just got to fine tune what you're doing. Okay. It's okay to be wrong. Regardless of what you're taught in school, it is okay to be wrong, especially in trading. All right. In fact, this is probably one of the few things where being wrong is what's going to help you become better. As long as you're managing it correctly. But losses can definitely lead you to become an emotional trader. If you find yourself getting happy or sad a little bit to the extreme when you're trading, you probably need to dial it back a little bit. And we'll talk about that some more. Another thing that losses can do, and especially consistently losing can do, is make you question your trades. So a lot of times traders will, have a streak of losing, rounds and trades, and they'll assume that, hey, they don't know what they're doing. When in fact they do. It's just like the market cycle could be different. They could be in there with too much position, too heavy. The stock that they're trading probably has telltale signs that they shouldn't be in it, that they're not seeing. It's a lot of different things in there, which is why journaling is important and why you want to review that, so you're not, especially during losing streaks, so that you're not questioning your trades that you're taking, in that process. Like I said, we're gonna discuss a little bit more in detail how this is gonna work and how to fix this as well. Revenge trading. I've definitely been a victim to this, where, especially if you find yourself chasing these stocks, especially when they've gone up. Revenge trading happens a lot for people who have, lost countless times. And then when I say a lot, that's relative to you, how you feel as a trader. Some people can lose 4 or 5 trades and assume that's just a little bit because they scalp and they trade a lot. Someone can lose 2 or 3 trades and that could be a lot, even though it might be a small percentage that they lost. Doesn't matter. It's relevant to you and your trading side, but revenge trading can easily creep in the more that you are losing in your trade. So understand that you are going to have to look out for that when you're reviewing your journals. Like, hey, did I just get in this trade to just revenge trade it? Was I just angry because I lost so much? Understand that. So you'll know that could be the reason why that particular trade you took was a loser trade. So look out for that when you lose. Now let's talk about winning. Winning. So we all want to win, right? The problem with winning, and I said this earlier too, especially for those of you that might start out, if you're winning too much in the beginning, you could become very, very overconfident, arrogant. You'll start taking trades you shouldn't be taking. risking more money than you should be risking just because you think you're right and you're overconfident and you've been, right these last few times. So many biases and psychological aspects can fall into winning all the time that if you don't know how to check yourself and check that, it's going to be a bad day for you. All right. And you're going to end up losing a lot more than you would definitely want to. I know because I've done it before. That's actually how I blew up my third account when I first started out. It's on a hot streak. But anyways, that's another story for another time. We're here to learn. But yeah, so that's pretty much what a lot of wins can lead to. Now let's talk about impulse trading. This is just you thinking that you may find like a quick little way to make money, and you're just gonna jump into the trade, and make some money. You're not thinking about risk management. You're not weighing out the odds. You're not considering all the things you need to be considering when taking this trade. And you're just impulsively trading because you haven't traded in a long time, or you have been trading in a long time and everything's just been hitting right. There's no way you can lose now. You're just going to jump into it. Boom. No, lady luck is not on your side. The market is not a place for luck. Understand that. Impulse trading does happen, especially when you're winning a lot. More so when you're winning a lot. And then last but not least, of course, too, false sense of accomplishment. The problem with winning, like I said, of course, especially in the beginning for traders who are trading in the beginning, even advanced traders, they'll win so much, or they even have a good win percentage. They'll have 3 wins for every 1 loss, and the 1 loss is small. They start winning, they're getting they're getting over really confident in their trading and their trading strategy. However, actuality is that they've only been getting lucky. If you look at the bigger picture of your strategy, there's going to be instances where it doesn't work. And all it takes really is just for that one time for it not to work, to where it wipes you out and you're done. So I'd much rather have a trader who's lost before because they know what to look out for than someone who keeps winning and doesn't really know how to lose. And I'll be honest with you guys, I think it's very important for every trader, especially for someone who's taking this seriously, to blow up an account at least 2, maybe 3 times. I ain't gonna tell you how many times I've blown up accounts, but at some point it does eventually click, and you start to, done this so much and practice so much, you become consistently after that and know what to do. But I just personally think it's good for a trader to blow up an account. I would be worried about someone who's never blown up an account. Okay, so yeah, keep that in mind. These are the effects of wins and losses. So when you're winning and you're losing and you're reviewing your trades, make sure you are understanding these and looking out for those when you're reviewing your journal. Okay. All right. All right. Now, one of the big things here that you guys wanted to kind of look at too, of course, is how to bounce back from a losing trade. Few steps you can do. Now, there's always an excuse for a losing trade. Some are actually good excuses, but other traders will ultimately need to understand that they got to accept all the risk, all the responsibility. Until you do that and you accept that you are responsible for all of it, for whatever happens, whether it's, orders, et cetera, history is just going to repeat itself, okay? The same thing is going to happen again and again and again. So you need to be able to accept that you losing a trade just happens with all the risk. And sometimes you could do everything right and your trade could still be wrong. It just happens. All right. Next thing, of course, after you've, lost, had a couple of losses and things like that, and you step back and you realize, you know what, this is my fault. It's not nothing that, someone else did. I just, needed to take responsibility of it. Next thing you need to do is realign your focus. A lot of times people will lose sight of what exactly they're doing with their trading strategy. And, where is that? Just because they lost so much, that just kind of throws you off mentally. You're thinking you're going to start, again, questioning your trades, questioning your strategy, and you're going to just be all out of whack, and you're going to feel like you're starting from scratch just because you've been losing so much. Dial it back, accept the responsibility, understand that, hey, it just happens. Now we need to refocus onto what we need to be doing here, which of course is finding a sound strategy. Let's take a look at the checklist that was in, the first tutorial. Hey, are we here? Are we here? Are we here? Does this look good? Does this look good? You got to realign that focus, okay? Or are my entries and exits correct? Am I doing something different than I should have been doing? What was level 2 looking like? What should I have noticed? I mean, there's so many different things. You just got to realign your focus to the actual trades, okay? And that's why you need to be reviewing that trading journal and realigning your focus with your trading strategy. Once you kind of got everything back in focus, You think you think you got everything together. Next thing to do is not to trade, but you're going to practice, okay? You're going to go into a demo account, whatever broker you're using. Now you're going to practice your trade, just your strategy. Don't worry about the psychological aspect of it. You're not using real money. Don't worry about how it's going to make you feel and all that stuff. Practice the strategy in your demo account. All right. How did that play out? Try it for a certain period of time. I'll discuss more of that in detail with you guys here when we're done in the advanced course, but practice, practice, practice. This is just going to help rebuild your confidence that you know your strategy is, you know, there and it is actually working, and it's going to just help realign your focus and, you know, make you feel better about accepting that responsibility because now you see that it's actually working. All right. Now, once you got your confidence rebuilt and you practice it, it's looking good. Now it's time to actually trade. However, here's the thing though. What you're going to be doing there at that point is starting small. Let's say, for example, you trade with, you know, 100 shares per trade. You're going to drop that down a lot. Excuse me. I used to say, you know, this might sound dumb, guys, but I say, hey, start with, you know, 5 trades, 10 trades. Even though you originally trade like 100, start with 5 or 10. Maybe even start with 1. There's been times where I've done that. Like, hey, I'm just start with 1. Let's see if my strategy is working again. Okay, boom, perfect. Now, when you're doing this, do not worry about the dollar amount, guys. Focus maybe on the percentage and the execution. Don't ever look at the dollar amount. Because if you're hitting your percentage, you're hitting your targets. The same way you're trading with 1 share, you could potentially trade with 5 shares, 100 shares. Right now, we're at the point to where you just need to rebuild that confidence and test out your strategy in real time and see how it really has a psychological effect on you because now you're using real money. Strategy is good, but now you're using real money. Make sure when you're reviewing those trades, how do you feel when you're doing those trades? So, and then look out for those fallacies. So, pretty easy there. But that's what you're going to do. That's how you bounce back from losing trading streaks. Okay. Time and time over again, test it. Works well, works wonders. So let's go over to the next one here. Now, winning strategies and what to watch out for. Let's say you're on a hot streak. You're winning your trades. Great. Kudos to you. Keep doing it. Keep making that money. You need to look out for being overconfident. You need to look out for being greedy. At what point do you know that you're not overconfident? You're just, executing your trade well. Well, how do you feel when you're done trading? Are you excited that you made this money? Or is it like, hey, I'm excited I executed that trade pretty well. That looked good. Oh, the stock continued to run. Okay, that's fine. But still, I did my part. Great. Okay, perfect. But if you're in there and you're executing the trade and you're like, man, I should have got some more. I should have stayed in. You're being greedy. Point blank, period. And you need to check yourself because that's not part of what trading is. All right. There's still a way to get what you might have missed without having to do that. And we're going to talk about that in the risk to reward management course of the section. I'll walk you guys through that stuff. So, but still, understand that is possible when it comes to winning a lot. It happens all the time. Another thing is seeing patterns that do not exist. Oh my goodness, if I had $1 for every time I've seen this with new traders, I wouldn't need to trade no more. So, especially for you guys that were in like the beginning course and like that, how we studied like price action and chart configurations and setups and things like that, you're going to be seeing strategies that aren't even there because you've been winning so much. Like, what are you looking at? So you really got to make sure you're grasping that concept when you're reviewing the trades too, like making sure you're actually seeing what you should be seeing. The next thing that you're going to be looking at is, need to watch out for is second guessing your strategy. The moment, a trader starts winning and winning and winning, then boom, all of a sudden the trade doesn't work. They're going to start second guessing like, oh, maybe this was just a bad strategy. Don't do that. Don't do that. There's nothing else in detail I need to go into. Just don't do that, okay? Don't second guess your strategy. If you need to, test it out again. But we're going to discuss like how often you should look for it to fail and like stuff here in a second, all right? And then the next thing, of course, is don't lose sight of the market. Just because you're winning and winning and winning, don't neglect the bigger picture of the overall state of the economy, the market, the sector that you're in, et cetera, because that's eventually going to take a toll as well too. So keep that in mind. Live traders will get on the hot streak and they'll forget what's going on. All right. Now let's get into the bonus section. Now that you guys know all this stuff here, Last one we're going to talk about here is random reinforcement. We're going to talk about what it is, the effects of it, and kind of key takeaways from there, okay? Oh, all right. So random reinforcement, guys, basically it relates to trading practices. Well, what it relates to trading practices, basically it occurs when traders, they'll misattribute random outcomes to their own skill or lack of skill, okay? That's basically what it is. Um, so I want you to understand this, that random reinforcement, just like in the world that you live in, happens, okay? Why does this happen? And why does this fallacy, take apart? Because as humans, again, we're natural pattern seekers, but the world as we know it is full of randomness, which is why the human brain doesn't like this, it's just state of the nature. At the same time, people like to feel like they're in change of like, in charge of like their own destiny. And, when random results occur, people kind of misattribute that to them doing something wrong that they've done themselves when it's not. It's just a random act of God. So yeah, but how does random reinforcement influence traders and affect traders? There's two primary ways that it does that. First thing that it can do, of course, is give like, novice or unskilled traders a sense of ability. Um, when, past positive outcomes happen and it's just due to chance alone. The second way, of course, is by, like a string of bad luck, which, might influence their, skilled, you know, that they have already, but where otherwise like a skilled trader, um, no doubtly wouldn't abandon, a good strategy that they have, but an unskilled trader probably would. So, those are the two ways that it can really affect, people. Well, actually, let me kind of go back to that too, because for example, like relying on randomness. Let me just kind of give you like an example because I think I kind of seen this one as well too online. Pretend like you're a new trader with like a business background who, you watch the news and you follow like the stock market and, you haven't traded so far yet personally, but still you think that you have, what it takes to be a good trader and, you got the trading strategies, an idea of it, but you haven't written it down or you haven't, practice any trading methods or anything like that, right? So you open up a trading account, you believe that, with your knowledge and background into the markets, it's going to make you a profitable trader. Pulling up, a price chart for the first time and you see all these stocks here that are populated, all this good stuff here. You quickly buy, like 200 shares of the stock and then, without even thinking, now the stock, continues to rise and rise and rise. And then, during lunch, something happens, you come back and, you know, you sell the shares, you make like, $100 in profit or whatever. And now all of a sudden you think that, hey, you know, let me go make another trade. Now you do this other trade and you got a similar results. Now you think that, oh, you got a knack for trading because you just had, two profitable trades back to back. Analyzing this situation, a trader that's, experienced in the market is going to look at that and, see how this, could lead to a really, really short-lived trading career. The main problem that a handful of successful traders, they're simply not, a valid sample size at that point for them to be even profitable in the long run. You only made two trades, okay? Um, and you need to make sure that you don't fall into the trap of believing that, your current method is going to be able to, you know, be profitable all the time and not be untested. It's not going to bring long-term success, guys. Okay. So the danger just kind of lies in just refusing to believe that, it was just all random. Okay. To refuse that you think you need proper guidance and all that good stuff to be able to come, self-sufficient in the market. So just kind of keep that in mind. Traders, a lot of new traders strongly believe that, and the market doesn't reward randomness. Okay. Or like erroneous thinking like that in the long run. Okay, um, so keep that in mind. But yeah, so another one, of course, too, was like I said, abandoning like a sound strategy. So let's say with random reinforcement, you've been in the market for a while. This is a lot of times for you advanced traders and intermediate traders, and realize that the market's kind of approaching like your approach to it is well thought out, well written, research plan, all that good stuff. Um, and, pretty much you start to get into the trade, and the problems were evident in the first example that I was just kind of going over. That solid trading strategy and the plan for approaching the market, and the method that you have worked well in the past because you did it earlier and it made profits. Assuming that now that you're still into another trade and you have a loss, it's bad. You're going to just abandon your strategy, and you shouldn't do that. Forget about the past success that you had with the strategy. If it led to 9 consecutive great trades with your trading strategy, and you're worried that the trading strategy you're using is no longer going to work, and you quickly change your plan or strategy to something else, that's a big problem because you're not considering the fact that it might be random, the fact that it didn't work. Okay. And this is why we're going to go over in a second here for those of you guys that are in an advanced trading course, this part of the sample size and testing your strategy of what you should be looking at, because there's always a certain level of randomness that can happen throughout the market that you need to account for, especially when managing your risk. So that's why it's very important to have a plan and make sure that the plan is going to be successful, but not all the time. Okay, determine that it can simply just run or run out depending on current market conditions. So keep that in mind. Okay. All right. So let's quickly recap this here.
All right, guys, you know the routine. If you enjoyed that video, please do us a favor, show some support and hit that like button. Give us that thumbs up. Let us know if you enjoyed this content. Comment below. Let us know your thoughts. We love hearing from you as well too. Feel free to reach out if you have any questions about anything whatsoever. Be more than happy to help you out. Until then, stay green.